equity market side, things are a bit cautious, but we'll start the show with some good news. And this is coming on the corporate earnings front. In fact, we are looking at very good upgrades for the first half of the fiscal, which just concluded yesterday. Let's take this forward. ICRA has released its report discussing some of these key findings, the hits and misses when it comes to the corporate earnings front. Jitin Makkar, head of credit policy, is now with us in terms of just the ratings profiles. I was looking at some of the data that was released, and it's interesting that, I mean, at the end of the first half, Jitin, it seems you've seen the highest pace of upgrades in the last decade. That's quite a statement. Tell us more about the findings at the end of H1.
Yes, it's been a busy time in terms of rating activity, and unlike the past couple of years, FY20 and FY21, where the downward momentum was quite high, surprisingly, or perhaps not as surprisingly, from November 2020, things have turned the other way. So from November 2020 onwards and until the month that just ended, we upgraded a large number of entities over the past 11 months, 10 months or so. And a large number of entities over the past 11 months, 10 months or so. And indeed, you're right that the numbers suggest that the pace of upgrades was almost at a decadal high. So certainly the headline numbers suggest that it's been a recovery of sorts that's been pushing up upgrades. But as is always the case, that there is more than meets the eye. Even as the number of upgrades, the pace of upgrades has been at a decadal high, but this does not necessarily suggest that the performance, the business fundamentals of many of these entities has reached the pre-COVID level or the level that we had seen in FY19. So most of these upgrades that have happened since November 2020, and particularly in the past 6 months, have been driven by firm-specific factors. Many of the entities successfully deleveraged, sold off some of their assets, and this asset monetization also helped them deleverage. Plus, many of these entities were able to improve their market share. They were able to get equity infusion. So the headline number suggests that things have turned amazingly better. But underneath these headline statistics, I think it's a more nuanced view that we have, which is that these upgrades are not really a reflection of the P&L restoring to its pre-COVID levels. The balance sheet certainly has upgraded a lot.
Okay. Jitin, that point is taken, but I wanted to ask you a more forward-looking statement. Now, with mobility increasing and the economy recovering, and a lot of the sectors which were impacted directly because of COVID-19, such as hospitality, what is the kind of recovery that you're probably anticipating within those sectors, the consumer-facing ones?
So it depends on the reference point. If you are speaking of the past year and compare that past year's weak performance against what lies ahead, then certainly one can say that recovery is a near certainty. Sequentially, we would expect the hospitality segment, aviation, and many other segments to report sequential improvement. But regardless of that, I think most of these sectors are still currently not really out of the woods. In fact, our outlook on both these sectors, hospitality as well as aviation, continues to remain as negative.
Jitin, you made a very important statement, and I'm seeing that reflect in the release that you folks put out as well, because you're saying that notwithstanding the large proportion of upgrades, the underlying business fundamental metrics across most sectors are unlikely to exceed pre-COVID levels. Why the pessimism? Because the reason I'm asking is this: if balance sheets are improving and if there is demand visibility, that is typically a precursor to the start of a new capex cycle. At least that's the hope with which sort of one was moving. But you seem to be suggesting that that's not the case. We shouldn't be so optimistic?
Again, as I mentioned, that it depends on you're comparing the prognosis against what reference point. So we've seen the trough, of course, that's behind us. But yes, we do expect that the capacity utilizations are still subpar at the moment, by and large, at the overall macro level. Even in case of the hospitality sector, the occupancies are not really they could have been. Of course, the recovery is going to be prolonged for contact-intensive sectors, and aviation and hospitality, I think for them, it's going to be a long road.
Okay. Jitin, if you could just quickly leave us with two sectors. One sector which you would probably bet on and be most bullish on in terms of the maximum number of upgrades, and the sector that you wouldn't be bullish on in terms of performance even despite the economy recovering.
I think the data that we have published, it does categorize entities that have seen an upgrades into neat buckets, neat sectors. But I think the core message there is that it's not necessarily sector-related tailwinds that are going to have a bearing on the improvement of the performance of the rated entities going ahead. So it might be a simplistic way to approach this, that which are the sectors which might see a good tailwind. We would again, we maintain our view that it's going to be entity-specific developments that are going to be driving the upgrades going ahead. Of course, there would be sectors like ferrous metals or non-ferrous metals where it's a general uptick in the price cycle that's going to take all the players up. The tide is going to take all the players up. But that cannot be said for sure for most other sectors.
Okay, so that's some caution on the table. We'll keep that in mind. Jitin, thank you very much for giving us your perspective on the rating upgrades that have come through on the corporate balance sheet front. But Jitin, they're saying that don't get carried away. It doesn't necessarily mean better tidings on the P&L front. We will take a quick break.